Welcome, everybody, to another episode of Beyond the Case, which is a podcast where global leaders from Harvard Business School's OPM community join in a personal capacity to share the real decisions, life principles, and mental models that go behind building enduring companies. My guest today is Alejandro Diez Barroso. He is a managing partner of DILA Capital, DILA Capital, which is a Latin America focused investment firm. And over the past 25 years, he's been both a founder as well as a private equity investor, a venture capitalist. He's backed over 60 companies, from what I understand. And so he is an incredible individual to speak about the entire landscape of entrepreneurship and investment across Mexico and the broader Spanish speaking world. How are you, Alejandro?
Very good, Sohan. Thank you so much for the invitation. And as I said when we were off the mic, really appreciate this that you're doing not only for the OPM community but for all of your listeners. It's wonderful to be able to be here with you, and really appreciate the invitation.
Absolutely. So, Alejandro, tell us about DILA Capital. Is it DILA or do I say DILA Capital?
DILA. So it stands for Development in Latin America.
Okay.
Yeah, so we've been running the firm for over 13 years now, and I consider it my startup. I've been in the startup world for a long time now. I actually started several businesses before I started DILA Capital, and I've always been fascinated by how you can solve problems that we're facing in the world through business. And I think that DILA was not an exception in that sense. So I started, like I said, a couple of businesses before I started DILA, and all of them were trying to solve certain issues in the market. But the biggest issue that I faced as an entrepreneur when I started businesses in Latin America was the lack of capital. So just to give you a little bit of an idea, my first company, I started it in the year 2000. There was not a single venture fund in the entire Mexican ecosystem. I sold that company in 2004. I started another company in 2005, and again tried to raise capital, and there was nobody giving capital to entrepreneurs in Mexico. So when I sold that company to a private equity firm in 2008, I started to understand the capital markets, and I started to understand that there was actually capital out there, but there wasn't any capital in Latin America. So we started DILA with the idea of starting a business that would solve the issue for entrepreneurs, that there wasn't any capital available in our markets. And as you said, we've been doing that for 13 years now. We've invested, as you correctly said again, in over 60 startups. And while we are very Mexican, and we can go into as much detail as you want about our investment thesis, while we're very Mexican, we invest in the Spanish-speaking world. We've invested out of businesses in almost all Spanish-speaking countries, including Spain and the U.S. Hispanic market, and obviously a lot of countries in Latin America.
Great. You mentioned you've started multiple businesses. You sold your first company in 2004, started another one in 2005. Why did you start another company so quickly? Usually, starting and building a company can exhaust someone. It's like raising a little baby, trying to do the whole thing again. So many sleepless nights, etc. The emotional journey, not just for you but for the entire family. So I'm curious, how you had the motivation to think about starting out again. Was there a strong pain point you felt, or were you eagerly seeking out new ideas?
Yeah, so the first company I started, I was very young. I started when I was 18, straight out of high school. I actually did like a sabbatical year between high school and starting college to start this business. And I ran that business through college. And I was very lucky. I was very fortunate because it was a success story, but I was doing it part-time. And when I came out of college was when I tried to raise money for that first business. And again, there was no venture capital whatsoever. It was impossible to raise capital. And so I had to sell my business, not because I wanted to, but because the business needed capital. I found, a strategic partner that can buy the business and scale the business for me, because without capital, it was really tough to do. And so when I sold that business, I said, okay, if I dedicate my time now full time to starting another business, maybe I can raise capital, maybe I can scale quickly. And both of them were in the e-commerce retail spaces. And so I knew the space very well. I did see opportunities in the market, and I decided to start the second business full time. And however, I mean, it was successful, but again, we were suffering the fact that there was no capital available, and we had to bootstrap. We had to, grow with the own resources that the company was making, and we never raised money because there was no money available. And so when I sold that second company, I said, okay, I want to start something else. I want to start something that is going to solve the problem that I personally faced as an entrepreneur in my prior businesses.
You sold your second company to private equity. Could you walk us through that experience end to end, from deciding to sell to diligence to life after the deal closed? What were some surprises along the way, or what founders could misunderstand about what they're really dealing with when they sell to private equity?
Yeah, of course. I mean, it's not going to be as an interesting story as I would like, Sohan, because at the end of the day, my second startup, I started a retail and e-commerce business, but I ended up partnering with a French brand and I brought that brand to Mexico and Latin America. So basically, we did a joint venture with a French brand to bring their business into Latin America. And when we did that joint venture, we signed a tag along and a drag along deal where if the company were to be sold at a worldwide level, we can tag along to the sale. And if we wanted to sell the company, we can drag along the investors with us. And that's exactly what happened. A private equity firm from India came along. It was called Fashion Fund One. And Fashion Fund One wanted to buy the brand at a worldwide level, and they bought the Latin American arm as well, or we decided to tag along. The decision was pretty easy for us because while we were growing, we built that company here for 4 years. We grew to 6 owned stores, around 40 points of sale, the e-commerce brand. We were doing quite well. And again, we did that with very little capital. But when there was going to be a change of hands to the private equity firm, we're going to change our partners. We were going to change the way we do business. It was an easy decision for us to tag along to the sale. It was also a good opportunity for liquidity, which is something that is very, very difficult to do. We can talk a little bit more about that further on in the conversation, because today what we do in DILA is we invest in businesses looking for liquidity opportunities in an 8 to 10 year time frame, and liquidity is very tough to do. So, one of the big learnings is when you have the opportunity, if that's your business model and you're building to sell, when you have the opportunity to sell, you should definitely take it. And then the other thing is it was an easy decision because we didn't have much of an option. Our partners wanted to sell the entire company. The buyers wanted to have the Latin American business within their acquisition. And so we didn't have much of an option. But what I did learn there, so my biggest, I did go deep into the process with the entire company. And I learned a lot about the private equity and venture capital business. I learned what their motivations were, how they do the diligence, how they do their underwriting, and how well you have to have your business prepared from a governance perspective, from a financial perspective, in order for the company to be sold. Companies, term sheets come and go, LOIs are signed all the time, but to actually close a deal, there's a lot of M&A risk, and that risk usually comes from not being prepared. And that preparation is usually having things in perfect order. Again, from a governance perspective and from an institutional perspective, your financials have to be in order. And that's something that is incredibly important in the private capital markets.
Incredible. You've bootstrapped the two businesses that we discussed till now, and you eventually sold them because there was no institutional capital. That must have been a real constraint, a real risk. And so when you look back today, how do you think about bootstrapping and how that shaped the way you built, led, and made decisions when you were an entrepreneur? And what lessons from your journey back then still guide you today when you think about ownership, control, and long term value?
Yeah, so I would tell you, Soken, that there's, in my general view, and I don't want to be too journalistic, but for the purpose of this conversation, I would believe that there's two types of businesses that we've seen: businesses that are built to sell and businesses that are built as lifestyle businesses. And they are very, very different. And none of them or neither of them are correct or incorrect. But the strategy that you have to implement if you're going to go one route or another is very, very different. So in my particular case, I actually built both businesses to sell. I knew that I wanted liquidity events. I knew that those weren't businesses that I wanted to stay with my whole life. And so what we really wanted to do was prove that there was product market fit, scale as much as we can with the limited resources that we had, and then be able to sell that to somebody that can really take it to the next level. And that's what venture capital is for. That's what we do today. What we do is we find business opportunities, ideas, or business models that we believe can scale tremendously, but that there's a clear exit path in, again, 8 to 10 year time frame. And that's one way of building businesses, which is perfectly okay. You need capital. You need to be very, very risk taking. And then there's the other route, which is I want to build a business for a long time. This is what I want to do for the rest of my life. I want, my kids to eventually be on the board or run this company. And it's a lifestyle business that, again, it's perfectly normal. And we love those types of businesses, but they're not venture backable businesses. Why? Because venture investors and private equity investors need to exit their investments. And so the way you come about taking business decisions, the way you come about, in your strategies is completely different in both routes. And what I've seen a lot is that entrepreneurs make the mistake of raising venture capital just for the sake of raising venture capital or for having a valuation or for wanting to raise cash. And then the moment that they realize that they've partnered with someone that is going to guide their decision making and probably force them to sell their company in a X amount of time is something that they never really thought through. So venture capital is not for everybody. Venture capital is for a very select group of businesses that can not only scale to, huge amounts of valuations, but you have to take on a lot of risks in order to do that. I know that you've interviewed a lot of our OPM classmates and you talk about risk and how they view risk. For us, risk is always, it has to be balanced out with returns. We always think about risk with returns. The more risk we're taking, the more returns we have to expect. When we invest in businesses, so maybe in our 20 portfolio company, in our portfolio of 20 companies, maybe 30% of them are going to fail. They're going to be worth zero. And to us, that's okay because we have a diversified portfolio and that's part of the power law and it's part of the venture capital model. But for that one entrepreneur that failed, it's their whole life. And you have to be okay with that risk. You have to be okay with the fact that if you're raising capital from venture capital investors, from private equity investors, if your businesses fail, it's part of their business model, but it's not, the outcome that you would like, and it's not part of your plan. And so taking on those risks is definitely, it could be very expensive. The outcome, again, when you think about the balance between risk and reward, is tremendous. But again, it's not for everybody. Really, my biggest, when I speak to entrepreneurs and they're asking me for advice, my best advice is don't raise capital just because you want to raise capital or because you need capital. Fortunately, today in the world and now in Latin America, there's a bunch of buckets where you can get capital from, and capital is definitely a commodity. You have to really understand who you're raising capital from, what are their incentives, what they're looking for, what their timeframes are like, and they have to align with yours. You are the captain of the ship. If you haven't raised any capital, in your business today, then you control absolutely everything that you want to do with your business. You don't have partners. You definitely have a lot of stakeholders, but you don't have shareholders. And so you can decide the future of your business. Once you invite somebody into that company with you, then you're going into a very strong partnership and the decisions are no longer yours and the shareholders are as much as stakeholders as you are. And so that's a very, very tough decision that entrepreneurs have to take when raising capital. And so coming back to your original question, we raised capital from friends and family at the beginning with the idea in our businesses to sell them. And so we knew that we had a very clear North Star. We knew where we wanted to go. And that was the plan. If I had raised from, venture and didn't want to sell, the story would have been definitely very different.
Thank you very much. For a second company, you mentioned tag along rights. Clauses like these are something that most entrepreneurs may not consider twice when they're signing paperwork, right? And so they might go ahead with the transaction without fully understanding the rights that they're either signing on to or the rights that they have with them. And so looking back on your journey as a bootstrapped founder and later selling your companies, how do you think your understanding of the importance of these terms evolve? And is there anything you'd want to share in terms of advice for young entrepreneurs today?
Yeah,
Around
100%.
some
So
of these clauses
I mean,
on how they could affect the outcome of the transaction?
totally. Most entrepreneurs, when they think of terms, they think of valuation and dilution. That's all they think about. How much money am I going to raise? What's the value of my company? I'm going to be diluted 25%. Check. Valuation is one of many, many terms that you have to fully understand. The biggest one to me is preferred shares. Most investors, when they invest, institutional investors, we asked for preferred capital. What that means is I'm going to put in, let's do rough numbers. No, your company is going to be worth $4 million pre-money. I'm going to put in $1 million. It's going to be worth $5 million post-money, and I have 20% of the company. And so you think, cool, this guy only owns 20% of the company. Yes. But if the company sold at $1 million, I get 100% of that capital because I have preferred shares come before you. And so the more money you raise, at preferred shares, your what they call pref stack becomes very, very big. And so there's companies out there that have raised hundreds of millions of dollars that have been successful. And you hear, oh, this company was sold at 300 million. Yes, but unfortunately, the entrepreneur that started the business, that struggled, that, built and then sold got zero. Why? Because the pref stack was worth $300 million. And when the company was sold, the founders got nothing. And so the preferred shares is something that, people really have to understand because there's different types of preferred shares. This exercise that we just talked about is what we call a 1x preferred share, and it's a non-participating preferred. There's another thing called participating preferred, which I absolutely hate. I always tell people never accept participating preferred in no circumstance, because what participating preferred says is you give me the $1 million back that I invested in this original exercise that we walked through, and then I still own 20%. So imagine the company sold for $2 million. I get my $1 million back, and then out of the other million, I get 200K, which is not the case with preferred shares on a 1x preferred. I would get the 1 million, and then you would get 1 million and divide it up between the rest of the cap table. But with participating preferred, they participate in their preferred, and then they get their pro rata shares of the rest of the capital. Very, very expensive, and it's not uncommon to see. Again, it's something that I advocate completely against. But again, the type of shares are extremely important. I've seen 2x preferred, 3x preferred, even 4x preferred during very tough times. So be careful, because valuation is just one part of it. Then there's other rights, like you mentioned. Most investors want to participate in the companies on a board level. Be very careful how your board is composed. In early stages where we invest, we don't like to see management lose control of their board. And sometimes that occurs in very early stages. And it's also very difficult, and it's very risky for the founders. And then there's, a bunch of small items in the term sheets and in the LOIs that you have to be careful with. Drag along and tag along rights are exactly one of them, as you mentioned. And so basically the drag along right, what it says is, if I invest in your company, Sohin, and a big real estate financial firm comes along and wants to buy the business at a $100 million valuation, and I want to sell, you have two options. Either you either you sell the company with me, and so I drag you along to the sale, or you have to buy my shares at the terms and conditions that big firm offered us. So you have an X amount of time to come up with the money at the same terms that these guys are asking for if you don't want to sell. And if you can't, then I'll drag you with me on the sale, and I'll force you to sell your business, even if I have a minority. So again, these are the types of things that if you really don't understand what you're signing, it could be very difficult, because we have seen investors oblige companies to sell their businesses or entrepreneurs to sell their businesses in times that they don't want to. So, we can go on and on about terms and conditions, but you're definitely right. Having a good corporate lawyer to guide you through these times is extremely important. Reading the fine print of the term sheets and the LOIs is extremely important. And asking questions. From the moment that you're raising capital, people think that it's a interview, when you're coming to raise capital. And I always say that it's not, it's a date. It's very important for Sohin to ask Alejandro as many questions as Alejandro is going to ask Sohin. You have to understand who I am, what motivates me, how much money I can put into your company, why I'm investing in your company. You have to speak to other founders to see what their experiences has been like with me. What type of terms that do I usually put? How do I react in good times, but especially how do I react in bad times? Because again, capital is a commodity. If your business is good, you should be able to raise capital, debt, mezz from many players out there. You have to find the right one. So it's much more like dating than an interview. And I'm very surprised that we still see founders that, come to DILA, they pitch their business. And then when we ask them, do you have any questions for us? They say no. That's a terrible red flag. You should be as interested in who we are as, we are interested in who you are.
When a founder starts thinking about a sale, there are two hard questions. Am I actually ready to sell, and who would be the right buyer? Now, you've been through this journey multiple times, and so I would want your thoughts on how does one figure out that the timing is right to consider a sell, and how would founders think about positioning themselves and their business so the right buyers show up?
It's a great question. So I'm not sure I have the right answer, because although we've been through this, fortunately, many times, it's never the same. So we have the last company that we sold was a company that we invested in 18 months before selling. And again, our period of holding the companies or being with the companies is usually a 7 to 10 year period. And we'd only been invested in this company for 18 months. And we had a board and they said, guys, we just received an unsolicited term sheet for the acquisition of 100% of the company. We still had money from the round that we had raised. We weren't ready to sell. We didn't want to sell. And immediately all of the board members said, no, why would we sell the company today? We've only been invested in this company for 18 months. The company's going like a rocket. You guys still have capital. We don't want to sell. And the founder said, we didn't want to sell either, but the price that they're offering us is so big that this is the reason we created this company. It's going to give me financial security for the rest of my life. It's saying no to these guys is a risk that I cannot take. And so as a board, we decided to sell the business. From a financial perspective, it wasn't the amazing return that we wanted to have, Sohin. We usually invest again in a lot of risk and we expect a big reward with that. And so when we do the underwriting for the businesses that we invest in, we usually like to see 10x returns at least. This was a 3x return in 18 months. So the IRR was obviously amazing, but the multiple of invested capital wasn't what we had underwritten. So it was a really tough decision for us. But at the end of the day, we're very founder friendly and, founders are the ones that make or break these businesses. We're just tagging along for the ride. And so we decided to sell. And so that was unsolicited. We weren't ready, but the business was doing so well that it attracted the attention of one of the big competitors and that they decided to buy us out for a very, very large price. We've had businesses that we said, we believe we're ready. Why don't we contract investment bankers and we can hire them and see what they think? And so there's very professional processes as well, where you hire, the Morgan Stanleys or the JP Morgans or the Goldmans and the Rothschilds of the world. And you go through a process of actually preparing the business for the company being sold. And that is at a time where us as investors say, guys, we've been here for 7 or 8 years. We believe you're ready. We believe there's appetite in the market. Our time to sell the company has come. Are you as founders ready? And if they are, then going through that, very institutional process makes a lot of sense. And we've gone through those processes as well. And then there's times where it's kind of a hybrid, where you say, we might be able to sell. Why don't we go and test the waters? Why don't we speak to certain potential acquirers and see if there's appetite in the market? And to be completely honest, Sochen, that's something that we as venture capital investors do all the time. We are all the time talking to potential acquirers of our portfolio companies. We're always in contact with private equity firms. We're always in contact with secondary buyers. We're always in contact with strategic players that can buy the businesses because we don't know when the time is right. And it's very hard to time the market. M&A, as I said, has so many risks, but there's also a market risk that we just can't control. There's market risks that involve, exchange rates, macro, socio-political, and, we've been through 3 or 4 years that have just been terrible in all of these sense. And liquidity has been very, very tough. So you have to be selling all the time. If you're in the business of venture capital and from a founder perspective, then you know that you're going to have to sell your business or you're going to have to sell the shares of your partner's interest in your company. So you have to be selling all the time. Just like you have to be fundraising all the time, you have to be selling all the time. And you'll know when the time is right. When the offer makes sense. When there's appetite in the market. There's nobody better than the founder to have that sensibility of saying, this is the right moment because with somebody else, the company can do whatever it is that I can't at this moment.
You've been investing in LatAm and operating out of there as well. When you step back and look at the private equity and VC ecosystem in Latin America today, what do you think is fundamentally different from the past? And what makes you excited about where the region is heading?
So what has been different from the past is that we've definitely been growing. Which is great news. We started with literally zero capital invested in venture capital in the Latin American markets. When I started off in 2005, 2008, up until 2010, there was literally zero venture capital. And the whole ecosystem started to kick off when we started DILA back in 2012, 13, and it's grown tremendously. And so from having zero capital invested in venture capital, we hit a huge record-breaking numbers in 2021, which is, worldwide. There was infinite capital at that time. Interest rates were very, very low. And there was a bunch of capital out there. And there was $16 billion invested in venture capital in Latin America, which was mind-blowing. The numbers have obviously come down after the party. There was definitely the hangover that we like to talk about of 22 and 23. But the numbers have come up and now we're at a steady let's call it $4 billion invested into Latin America in venture capital in these past 3 or 4 years. So I think, having $4 billion is definitely exciting. There's money out there. There's serious funds. There's funds like ours that are now raising their fourth, fifth, and sixth funds. There's a lot of institutional capital from the US, from Europe, and from Asia coming into Mexico and into Latin America. However, it's still small. I mean, if you think about just talking Mexico for a second, Mexico is the 13th largest economy in the world. And we maybe invest 0.13% of the GDP of Mexico into venture capital. If you compare that to countries like, the US is obviously crazy out there, but it's 1.5 percent of GDP. India is probably 0.8, China's 0.5. So we could be investing 3, 4, 5, maybe 10 times the amount of capital that we're investing into venture capital into our economy. And we are true believers that venture capital, investments in technology, in innovation are one of the roads to development of our economies. And if we don't invest into that, then we could be falling very, very much behind. And I think that's the case. It excites me because we've grown 35% CAGR over the past 15 years in VC. However, we still have a long ways to go. I believe that part of that is a lack of liquidity in the markets. We're still yet to see big IPOs. We're still yet to see the first unicorn being bought out, by an M&A transaction. And we're heading there. It's not a question of if it will happen. It's a question of when. When that occurs, Sochen, I think it's going to create very, very valuable positive avalanche, and it's going to occur. We've had a tough 23 and 24 and 25 from a liquidity perspective, and this is not particular to DILA. This is not particular to venture capital or private equity in Latin America. It's a worldwide issue that we've been having. But 25 started to pick up. We started to see a lot of M&A action. We started to see IPOs picking up in the US. And there's usually a lag for that to come down to Latin America, but it does occur. It usually occurs 6 to 12 months behind. So we're very positive about 2026. I believe it's going to be a great year for the venture capital and private equity markets in our region. But again, there's just so many opportunities and there's still such a lack of capital that for one side, it really excites me because that's the opportunity that we're seeing. And that's why we're so excited about being in this industry in this moment in time. But on the other hand, there's way too many opportunities. There's an imbalance of opportunities versus capital. And so, I always invite everybody that I meet to come to Latin America, to come to Mexico City and see what's going on, because the opportunities are really endless.
There's a common narrative that many Latin America startups are either innovating locally or they are adapting models that worked in the United States. From what you're seeing as an investor, how do you think about that tension, and where do you believe is the most durable value in the region that is being created?
So I agree with what you're saying. And I think that the first startups that we were seeing in the early years of the VC scene in Latin America were definitely copycats of what was going on in the US or Europe. But what we're seeing, Sohin, is that we're leapfrogging a lot of the technologies. That is very common in developing markets. And so for one thing, you're right. But what we're seeing a lot is not necessarily copycats today. We're seeing tropicalization of businesses, business models, and business ideas being tropicalized to local problems. And that's what we're really excited about. And let me give you a couple of examples. In Latin America, or in the Spanish-speaking Latin America, because Brazil is definitely a different animal, but talking about Spanish-speaking Latin America, there's a huge lack of financial products and services. In Mexico, I don't want to get these numbers wrong, but around 30% of the population has access to banking services. Only 30%. Only 10% has access to credit cards. So there's a huge opportunity for financial technology companies to come along and solve these problems. And that's why we've seen a boom in the past 6-7 years of fintech companies taking over most of the capital and taking over the headlines. And those are the companies that are exploding in Mexico. Why? Because there wasn't access to capital. There wasn't access to credit. There wasn't access to financial products and services. And these fintech companies are solving these problems. Sure, they're looking at business models in the US, but they're tropicalizing them and they're modeling them in order to fit the problems that they're trying to solve in the local markets. And that's not new in the US either. It's very hard to come up with a completely new idea that nobody had thought of today. Everybody's stacking new ideas on top of each other until somebody finds that holy grail and somebody finds that new business model, but it's not something that they created out of thin air. It's something that they created, building upon technologies that were occurring in the past or business models that they saw from the past. And so that's not different in Latin America. Financial services is an issue that is huge in our countries, and entrepreneurs are solving those issues with technology and with new business models. Another one is software. Software, the guys from Andreessen Horowitz wrote an article, I think it was back in 2010, that said software is eating the world. Software is still not eating Latin America. It's going to eat Latin America, but it's not yet. We've invested in software businesses in the construction industry, in the restaurant industry, in the dental industry. Why? Because it's not penetrated. The dental example in the US, I think 90% of dentists have oral scanners in their, in Mexico, that's 7%. So if you offer digital products and services to dentists, the market is huge and you can make a really, really big business there. Why? Again, there's an issue that there's a lack of penetration of software in our countries, and that's where we've been investing heavily. And so we do look at the US, we look at Europe for guidance as to what's going to come next, because again, we're always leapfrogging in technologies and in tendencies and in what we're seeing. Not necessarily copying their business models again. We like to see businesses that are locally adapting. Now, what we are seeing today, Sohan, and it's what excites me the most, is that today we're not seeing Latin American entrepreneurs necessarily building businesses for Latin America, but they're building worldwide businesses. They are building businesses that can scale globally. And that is something that is very exciting. Obviously, they start in Latin America. They usually scale in Mexico. We're 130 million people. Mexico City alone is more than 30 million people. And so you have enough scale in our countries to build billion-dollar businesses. But the problems are not very different in Southeast Asia, sometimes in Africa, or even in countries like Italy, Portugal, Spain, in Europe. There are a lot of commonalities and a lot of cultural similarities. And so we have seen a lot of our companies being able to scale on a global basis. And that really excites us, because having Latin American technology being scaled at a worldwide level is not something that we had seen before. Again, it's because of the lack of capital that existed in the region. But now that there's capital available, talent is definitely something that is not scarce.
Transitioning into a different topic now, what made you consider the OPM program for yourself?
Yes. I mean, starting, I think very similar to you, Sochen. I know that you went to NYU, you went to a couple of programs in Harvard before joining the OPM program. I've always been a huge believer in constantly learning and constantly being educated. I did my MBA in Kellogg in Northwestern. And I love the experience. I absolutely love the experience. And I'm always trying to learn, always trying to um, surround myself with people that are, much more intelligent than I am. And I think that's what I love about my job. All of the entrepreneurs that I meet, whether we invest in them or not, are way smarter than I am. And I just love to be around them. And I think that that was what really attracted me to OPM. Eduardo, my partner, and Augusto, my other partner, are both HBS alums. And so they talk about HBS all the time. And, I always tell them that I liked Kellogg better, but I was always attracted to see what we can do with HBS. And at the end of the day, I've been building a venture capital firm in Mexico for over 13 years, operating in constant uncertainty. And so when I decided to go to OPM, I didn't necessarily want to go to learn, finance or strategy. I wanted to learn how to make better decisions under uncertainty, how to scale without losing coherence, how to lead more deliberately. And I think that what OPM, at least the first part that we've been through, gave me was not necessarily more ambition. It was just better judgment. The fact that I had the opportunity to get out of the office for 3 weeks, which was tough to do. And I think we can talk about that a little bit more. But having the opportunity of being with entrepreneurs like you really, really helped me to kind of understand the psyche, the ambitions, the concerns that entrepreneurs have. Being in this ambiance of trust, of complete transparency, being able to have really transparent communications with worldwide amazing entrepreneurs was great for me to, kind of see the game not from the pitch but from the stands. And so far it's been incredible, and that's what really attracted me to the program.
What did you enjoy the most in terms of any cases specifically, any professors that you still find yourself revisiting?
I mean, there's so many, but There was one thing that Professor Das said that really got to me, and it's something that we've been working a lot with the whole team since I came back, and it was the whole idea about the customer. Most of the OPMers, so can like you run a business. They run an operational business, and OPM is very focused on operations. How do I operate my business? How do I run my teams? And we talked a lot about the customer and how to make the customer a hero. And something really weird happened to me, Sohin, because I sat down and said, I'm not sure who my customer is. Is it the entrepreneurs that trust us with their dreams and trust us with their companies and they invite us to be part of their stories? Or is it the investors that we call limited partners? Is it the LPs that are trusting us with their money? And when I realized that I didn't know who my customer was, that was a big issue. And so kind of coming back and saying, who is my customer? How can I make my customer a hero if I don't know who my customer is? So in December, when we came back, we had a very long session with our entire team. We spoke to entrepreneurs, we spoke to our LPs to understand who's our customer. And it's interesting because there was like a huge, binary discussion where the founders are customers. And obviously, if you spoke to founders in the DILA portfolio, they would say, obviously, I'm your customer. And when you spoke to LPs, they said, obviously, I'm your customer. And at the end of the day, what we realized was we are a marketplace between founders and capital. But we have to treat both of them as our customers and we have to make both of them our heroes. And it's not something easy to do because there's a lot of conflicts there. There's a lot of times where one incentive is not aligned with the other. Balancing that act without realizing is probably my full-time job. And it's not something easy to do. And I had never really been able to pin it down as I did, thanks to Professor Das and thanks to all of you in class. And, it's an exercise that we're still working on, but it completely changed my mindset of how we run our business.
If you could speak to your younger self, what advice would you give him?
I've been digging deep into Stoic philosophy for quite some time now. And the biggest takeaway that I have from Stoic philosophy is that you have to live in the present. And very, very fortunately, right now, I'm at a place personally, family, business, where I wouldn't change anything. Obviously, there's a lot of things that could be better, they could be worse. But my big fear is that if I would go to myself 20 years back and give some advice, then things would change. And I probably wouldn't be here talking to you right now. So if I'm happy with where I am, I'm excited of having this call with you and I'm certain that something would be different. And that difference makes me so uncomfortable. And I'm just so happy with where I am right now that I wouldn't change anything. And so I would be very cautious of what I would say to my younger self, just because I wouldn't want any changes in my life today. If you forced me to tell him something, I would just say patience. I think that patience is a virtue that we have to have in life and in business. I think that very small acts accumulate. I'm a big believer in compounding anything, compounding interest, compounding health, compounding relationships, and it takes time. And so patience would be the word that I would use. But again, only if you forced me. If not, I wouldn't tell my younger self anything because I think that I'm very, very happy and proud of where we are today.
My final question to you is about a book that you feel has influenced your thinking a lot.
I'm a big reader. I love to read. I read a little bit of everything, very focused on business. If your question goes towards there, it's a book called The Hard Thing About Hard Things by Ben Horowitz. And it's a book that we give out to all of the entrepreneurs that we invest in, because it talks about the struggle. There's one particular chapter that is called The Struggle, and the struggle is real. And I've been through the struggle. Every single entrepreneur that we've invested in and that we haven't invested in has gone through the struggle. People usually think of success as a straight line from zero to whatever your measurement of success is. And it's nothing like that. It's nothing like that. It's a roller coaster, and it's been a roller coaster for every single successful entrepreneur that we've known or we've read about. And Ben Horowitz is a very successful entrepreneur, now a very successful venture capitalist. And I think he writes the book from a very personal and very profound way. And so we give that book out to everybody that we invest in. So from a business perspective, that's definitely the one book that has really gotten to me. And again, it's a gift that we give alongside our investments to all of our portfolio companies.
Given the scale at which you're investing and the fact that you've been an operator yourself, what do you think are some patterns that separate the founders who compound over time from the ones who end up stalling?
That's a great question. If I had to answer it in just what's one common denominator, I think it's the ability to sell. So people usually think of sales as I'm going to go and sell my product or my service to the market. And that is not the case. You have to sell your vision to your co-founders. You have to sell your vision to your investors. You have to sell your product and service to your clients, but you also have to do it for your providers. You have to do it to your shareholders, to your board, the people that you are hiring. You have to sell them on the vision. You have to sell them on the company. Selling is not something that, at least not in Latin America, it's not something that they teach us in schools. And they don't teach us how to sell. And you're selling all the time. You're not only selling your product and service, you're selling absolutely everything. You're selling yourself. So learning how to sell and being a good salesperson is definitely a very common denominator that I see in successful entrepreneurs that we invest in. From the moment they walk in the door, they're selling to us. And obviously there has to be a lot of context in it and there's a lot more there, but being able to sell your vision, your story, your passion, why you're building the business, how you're going to build it is extremely important. And to that comes hiring people that are better than you, surrounding yourself with people that are better than you, surrounding yourself with diverse people that can give you different perspectives. And all of that is part of selling, because you can have the best CFO in the world, but you have to sell him on the idea. Otherwise, he's not going to work for you because he has better options. And so having that ability to sell is something that they do not teach us. I truly believe that it's something that we have to teach and it's something that we have to learn, because I do believe it's an unfair advantage.
Thank you, Alejandro. Appreciate your time. Your responses were so detailed and thorough. I'm pretty sure anyone listening will have a very good perspective on how to bootstrap, how to think about liquidity and exits, and also what it means to either operate or invest in Latin America today. Truly, truly appreciate your time and the insights that you've shared.
And thank you once again for inviting me. And once again, I want to really, really thank you for this that you're doing, because it's great to be able to listen to 40 or 50-minute conversations with the other OPMers and get to know them better, because it's tough to meet 160 people from our class in the 3 weeks that we were there.
Thanks, Alejandro.
Thank
Talk
you.
soon.
Sure.